Hi guys, it's Stock Curry, and despite a deluge of bad news and bad earnings, the stock market traded flat, the NASDAQ went up. So what's going on? Well, I'm about to explain in today's video, so let's get into it. Thursday started off with the Producer Price Index, or PPI, rising faster than expected. In fact, it showed an 11.3% annual gain. Now remember, the PPI, or Producer Price Index, is a forward indicator of where the CPI, or Consumer Price Index, might be in the future, because it shows how much the goods and services that are produced in the US are going to cost in the future. As the price of the goods that are purchased by producers goes up, they have to increase the price of the goods that are sold in order to keep up their profits. So with an 11.3% increase in the Producer Price Index, this could literally point to an 11.3% increase in the cost of goods and services in the future. So this is a very important thing to look at. We did not want to see a number this high. This is not good news, and it means that even if oil and food prices go down, we could see CPI continue to rise if the goods and services rise faster than the oil and energy and food come down. So not good news. We'll have to keep our eyes on this in the future. Now, of course, this is going to affect how much the Fed raises their interest rates by, and the Fed Governor Waller came out today and said that he expects a 0.75% point hike. That's a 75 basis point rate hike, but he says he's open to a larger one. Now, this was interesting because the markets are pretty much pricing in almost guaranteed 100 basis point rate hike. And after Fed Chair Waller made his comments, the market started pricing in only about a 50% chance of a 100 basis point rate hike. And this is kind of what the Fed does. The Fed is going to fill out the markets. You're going to have one Fed member say 75. They're going to have another Fed member say 100. They're going to kind of fill it out, see how the markets go, and if they think the market can handle a 100 basis point rate hike, then they'll most likely go ahead and do that. And so this is just kind of the process we're in. I pretty much ignore this back and forth until we get a lot closer, and then as we get closer, the Fed starts to leak sort of what they're going to do in the day or two ahead of time so the market can kind of get prepared. So this is just part of the banter. Don't worry about it too much. I still think we're going to get the 100 basis point rate hike, and we'll probably get a little better idea of what's actually going to happen as we get a little bit closer to that Fed meeting that's coming up in about a week and a half. Now, more bad news that came out on Thursday was that the mortgage rates increased again, all the way up to 5.51% from 5.30%. And keep in mind, any rate increase above 5.5% officially puts us in the most unaffordable housing market in history, even more unaffordable than 2007. And with a rate of 5.51% that we're currently at, we are back to the most unaffordable housing market in history. So this is not good news for the housing market. It will cause housing prices to come down, but it's still hard to say what this is going to do to rental rates. It's kind of a wait and see right now, but as this mortgage rate continues to increase, the home prices will continue to decrease, and that is not going to be good for the stock market. Now, other bad news was the fact that the U.S. jobless claims reached the highest level this year. Last week's jobless claims were 244,000. That's the highest level in 8 months. Now, this is not good because remember, the Fed's whole purpose behind everything is to raise interest rates, get inflation down, while keeping the unemployment rate low. And so far, the Fed has always pointed to this huge amount of job openings that far exceed the number of unemployed as an indicator that the economy remains strong. But we have to keep in mind that those job openings are going to be for very specific skill sets, and the people getting laid off may not be able to fill those skill sets. So we could see job openings remain high as unemployment starts to rise. Now, so far, unemployment remains low, So long as unemployment remains low, the Fed will have no problem continuing to raise interest rates at a very aggressive pace. However, if the number of jobless claims continues to rise and it doesn't show any signs of slowing down, this could cause unemployment to rise and could send us deeper into a recession. Now, the other big news that came out on Thursday was earnings, and we've got to talk about 3 companies that reported earnings because this led to the back and forth in the stock market and also caused the NASDAQ to go up while the Dow dropped. So the 3 companies, the 3 big ones that moved the markets on Thursday were JPMorgan Chase, Morgan Stanley, and TSMC, which is Taiwan Semiconductor. Now, JP Morgan Chase and Morgan Stanley both reported a significant drop in earnings. In fact, both of them dropped by 28% and 29% respectively. And that was obviously terrible, terrible news for the stock market. The stock market opened deep in the red on Thursday. And the problem, though, is that these are big bank stocks, and they're heavily weighted into the Dow, and they're very lightly weighted in the S&P and NASDAQ. So this is what caused the Dow to go down today. But why did the NASDAQ rise? Well, it has to do with Taiwan Semiconductor. They reported an excellent earnings and reported an increase in demand, and that caused the NASDAQ to go up because of one single company, and that was Apple. Because TSMC reported great earnings, that led to the belief that there was high demand for Apple cell phones because Apple cell phones use these Taiwan Semiconductor chips. It's all related, right? So people thought there would be really high demand for Apple cell phones. As a result, Apple stock went up over 2%. And because Apple is weighted about 14% of the NASDAQ, when Apple went up, it brought the whole NASDAQ up with it. So that's why we saw the NASDAQ rise, despite JP Morgan and Morgan Stanley reporting really bad earnings and a really high producer price index and increasing mortgages and bad jobs number and all the bad news that came out today. It was literally Apple that rose that caused the NASDAQ to go up. So that's what happened today. Now, getting into the earnings we're going to have to watch out for on Friday, we've got United Health Group, we've got Wells Fargo, and we've got Citibank. Those are going to be the big 3. Of course, we also have a lot of other smaller banks reporting as well. So if these other banks continue to report bad earnings on Friday, we can expect the Dow to continue to drop. However, it's really unknown what the S&P and NASDAQ are going to do since we don't really have any earnings that are going to affect, especially the NASDAQ, on Friday. Now, I want to get into what JP Morgan CEO Jamie Dimon said in the earnings call because Jamie Dimon is one of the longest lasting CEOs of JP Morgan Chase. He's been through the 2008 financial crisis, and he has a really good hand on what the economy is doing and where it might go in the future. Now, before Jamie Dimon got into his dire warning, he said the U.S. economy continues to grow and both the job market and consumer spending and their ability to spend remain healthy. But I want to remind you that while people have money for now, consumer sentiment is the lowest it's ever been. And part of the problem right now is that while consumers do continue to spend as if everything was fine, they are running out of savings. Personal savings is at almost the lowest rate it has ever been. And as consumers run out of savings, they're also racking up credit card debt. In fact, credit card debt is the highest it's ever been. And as consumers run out of savings and they max out their credit cards, the consumer's ability to spend is going to fall off a cliff. So I don't agree with Jamie Dimon right here because consumer spending is about to come to an abrupt halt sometime in the next few months. That said, I want to get into the warning Jamie Dimon said. He said geopolitical tension, high inflation, waning consumer confidence, the uncertainty about how high rates have to go, and never before seen quantitative tightening and their effects on global liquidity are very likely to have negative consequences on the global economy sometime down the road. That is a mouthful. And essentially, if I could just sum it all up, The whole world's going to crap. It's about to catch on fire. Run for the hills. Okay, not literally, but that's kind of what it sounded like. Jamie Dimon was essentially saying things are okay for now, but they're about to get really, really bad, and we're about to have a global recession. Now, this is the same thing that everybody else has been saying. This is nothing new. So this kind of warning didn't necessarily cause the stock market to go out in fear and panic. We kind of already expected this, but it is disheartening to see Jamie Dimon, who is excellent and has a really, really, really good insight on the economy, come out and say this, because it's most likely going to happen and going to be true. Okay, that's all the bad news, and I know that was a lot of bad news. The good news is the market's holding up for now. The NASDAQ is really going to start moving over the next 2 weeks as we get earnings from tech stocks especially. And then as we get a little bit closer to the Fed meeting, we probably see a pretty big move in the NASDAQ as well. And then, of course, right after the Fed meets on Thursday, in 2 weeks, on July 28th, we get the Q2 GDP numbers, which will let us know if we are officially in a recession or not. Now, wow, we've got a lot coming up over the next few weeks with a major earnings, a Fed meeting, and a possible official recession number. We're going to have to keep on our toes. I will be here for you the entire way, giving you market updates every single day. I also wanted to let you know that on Monday evening, we are going to be doing a live stream with Larry Jones and Stocks with Josh right here on this channel. So go ahead and subscribe so that you don't miss that. You know, I noticed last night that I lost 125 subscribers in an instant. And a lot of people have been saying that YouTube has been removing subscribers. So even if you subscribed to the channel in the past, go check the subscribe button and make sure you're still subscribed. Because for some reason, YouTube has been unsubscribing people. So go make sure you're still subscribed. And if you are still subscribed, make sure you click the bell icon and click all so that you don't miss out on the next video and especially the live stream. And of course, while you're at it, go ahead and click that like button too. Helps out the channel and helps out the page. All right, guys, I hope you have a lot of success trading. I want to remind you that we are starting the Millionaire Club Challenge here in a few weeks. And that's where we're going to be doing a value investing portfolio using the exact same strategy Warren Buffett used to hopefully generate the exact same returns Warren Buffett generated. And if we are able to successfully do that, we will all become millionaires within the next 10 to 15 years, starting with $2,000 and depositing $200 every other week. So if you're interested in joining us on that, go ahead and get your Moomoo account opened, and we will get started with that shortly. It does take about a week to get your account open to get it funded, so that's why I'm having everybody just go ahead and get started now so that you're ready to go when we start the challenge. If you have not yet opened your Moomoo account and gotten it funded, I have a link for Moomoo down in the description of this video. Just go ahead and click that link and you can get your account set up. You're also going to get up to 10 free stocks when you use my link to sign up. All right, guys, I hope you have a lot of success trading, and I will see you on Monday.